Good afternoon, and welcome to the Florence School of Banking and Finance. My name is Pierre Schlosser. I'm the scientific coordinator of the school, and I have the pleasure to host today's, you might say, Shakespearean online seminar called To Fail or Not to Fail with Christos Gortsos from the University of Athens and Seraina Grünewald from the University of Zurich. A warm welcome to our two speakers. Grüezi miteinander. This is the third episode of our 2017 seminar series on banking resolution. It will be the last edition before the summer break, but there will be more to come in the autumn. In case it is the first time you join us, let me say a few words of introduction on our school and tell you who we are and what we do, as we usually do. The Florence School of Banking and Finance is part of the European University Institute located on the hills of Fiesole in Italy. The institute was set up more than 40 years ago and over the years became a vibrant international research institution in social sciences. Today it delivers top-class PhD degrees in law, economics, political science and history, as well as executive education courses. So our School of Banking and Finance focuses precisely on this latter aspect, executive education. It was set up in January 2016 as a European platform that brings together on the one hand practitioners and on the other academics from the banking and finance sector who all share the objective of enhancing Europe's financial stability. So alongside its policy dialogue initiatives, the school hence offers various executive training courses held over only a few days. So we combine both residential and interactive online formats, and our long-term goal is to shape the emergence of a common regulatory and supervisory culture in Europe. So since our establishment, the school has trained more than 800 experts coming from more than 40 countries. As you can see on our chart, our training participants were mostly active in central banks, but also in European institutions and agencies, as well as academia. In case you didn't or couldn't attend our residential courses, so far please note that we have 5 executive courses coming up after the summer. In September in Frankfurt on early warning systems, in October in Florence on bank regulation and systemic risk, in October in Amsterdam on the regulation of shadow banks, in November, still in Florence on global banking, and last but certainly not least on banking resolution in Florence. As a matter of fact, this will be a first of its kind autumn school on the law, economics and practice of banking resolution, co-organized with a newly created School of Transnational Governance at the UI. And it will be great fun. So if you're interested in those courses, my only recommendation is that you do not wait for September to register. So now, this being said, I'd like to move over to you because you're very numerous today. You're around 200, I hear, and that makes us very happy. I see, for example, that several FBF alumni have joined us, and it's a pleasure to see several familiar names in the virtual room today. So this is exactly where you come from. We have 49 nationalities represented today, and I therefore trust that the discussion will lead us beyond Europe for some moments. We're very glad to count on numerous participants from the ECB, from the Single Resolution Board, and from many other European and national institutions that we haven't listed here, as well as representatives from academia and the private sector. So this very nice European and global diversity is also illustrated by our word cloud, which features some of your first names. You might see yours. This is your platform too. We're balanced on the gender side, have an average work experience around 6 years. And one line more to tell you that most of you are economists, but there's also quite a large share of lawyers with us today. Lastly, most of you have a master's degree, while 23% of you have a PhD and 7%, as you can see, a bachelor degree. So I can feel a lot of skills in this room. Once again, I'm very grateful that so many of you are with us today and look forward to your comments, questions in the interactive session that will follow the presentations. So we'll rely a lot on you to make our conversation as interactive as this technology allows us to be. But here is first how this online seminar will be structured. Christos will provide us with a 20-minute presentation on the topic. It will be followed by a 10-minute reaction by Seraina. This will leave us then around 30 minutes of interactive Q&A where you'll be able to share your thoughts, comments, provocative questions in the chat box. The presentations will be punctuated by 4 polls where you will be asked to provide your anonymous views on a given question. And that's it. Voila. This being said, I'm very glad to introduce you now to Christos and Seraina in a bit more details. Christos Gortsos is Professor of Public Economic Law at the Law School of the National and Kapodistrian University of Athens. He's also a visiting professor at the University of Saarland, a research partner at the University of Zurich, and from late 2017, we're really glad to say, a Fernand Braudel Senior Fellow at the European University Institute. Seraina Grünewald is Assistant Professor for Financial Market Law at the Institute of Law at the University of Zurich, and previously she held research appointments at Harvard Law School, Yale Law School, and Columbia Law School, among others. So with no further ado, I will now leave you in their company and will tune back in for the Q&A session.
So good evening. On my behalf to everybody, thank you very much, Pierre, for this introduction and the invitation to participate in this extremely interesting and very timely topic on the resolution of credit institutions. Thanks to all of you who are participating. I see from the list of participants some people that I know, and it's not only because they are great, but some of them were my students. So kalispera to everybody. And I think that most of all, I would like to thank not only those participating from the ECB and the Single Resolution Board, but the institutions themselves, because they have taken some decisions during the month of June, which have made this seminar very, very topical. And as a matter of fact, it is during the month of June that the Single Resolution Board, one of the new agencies in the European Union, in operation since 2015 and full operations in 2016, has taken its first decision to resolve a bank, and has taken subsequently 2 decisions not to resolve 2 banks, 2 Italian banks. And as a matter of fact, in addition to another previous case, that of Monte dei Paschi di Siena, we now have evidence on all 3 potential outcomes of what I call the trilemma under the new resolution law, both the BRRD and the regulation governing the SRM, the Single Resolution Mechanism, consisting of the SRB and the National Resolution Authorities, because we have now cases, we had that before, case 1, in which a bank is considered to be failing or likely to fail, and this decision is usually being made typically by the supervisory authorities, in most cases by the ECB now for significant credit institutions, and that was obviously the case in 2015 for the large Greek credit institutions at that time. And when the credit institution is failing or likely to fail, but nevertheless it can cover the necessary capital shortfall or part of that by private funds, then the story ends there, and the credit institution can continue to operate. And then you have the case 2, which is when all 3 resolution conditions are being met, in which case the resolution authority takes the decision in cooperation with the supervisory authorities to resolve the bank according to the specific rules laid down in the BRRD and the SRM regulation, which more or less, or to a certain extent, are based on the BRRD, and in some cases they are just repeating provisions of the BRRD. And then you have the 3rd case, which was activated again this period of time in June, when the credit institution is considered to be failing or likely to fail. There is no reasonable prospect that it can get some private funds in order to recapitalize itself. But then again, it is not considered to be so systemically important that the resolution action is necessary, as it is called, in the public interest. And in this case, you don't resolve the bank, but you have the winding up of the bank according to the provisions of the BRRD, and it is there where we have some elements which became very important, and potentially they have triggered a lot of discussions, because in this field we have, at least when it comes to European harmonization, a loophole. And before coming back to this table again, let me just remind you where we are today and where we were some years ago. In this table, very shortly, I present all the measures which are now on the arsenal of the different authorities in order to prevent banking crisis and to manage banking crisis. And by the way, let me remind you, for the sake of completeness, that this table does not only apply to credit institutions, it applies also to investment firms. So this is another point which to a certain extent might interest us in the future. So we have crisis prevention measures and we have crisis management measures, and we had that before. The main, the new element in this is that we have two building blocks which are totally new. The macro elements, macro-prudential regulations, the buffers, macro-prudential oversight, the work of the European Systemic Risk Board at the European level, and then, of course, resolution, which is a new kid in town, according to our national and according to European law. And all this is part of our new legislation, with the exception of the rules on lending of last resort, in which usually you are based on constructive ambiguity and you don't have specific rules in legislation. On all of the other aspects, you have some kind of European law, and we know that right now we are working in the area of the European Banking Union, consisting of 3 pillars. I think there should be more, but we can discuss that. The first pillar is already complete. The second is also complete. The third is pending. We have a single supervisory mechanism, we have a single resolution mechanism, and a single resolution fund on the making. And we still don't have the single deposit guarantee scheme, the EDIS, which is in the making. And all this is coupled by harmonization of substantive rules on the prudential regulation of banks, on the prudential supervision of credit institution banks, on the resolution of non-viable credit institutions, and on deposit guarantee schemes. In the field of deposit guarantee, we do have a harmonization of rules, but we do not have European institutions yet. And I would like to stress a point here that even for significant credit institutions, those which are being directly supervised by the ECB and for which the European agency, the Single Resolution Board, is responsible with regard to their resolution, we still have some national elements. And one of the most striking examples is the framework on the winding up. I would not touch upon the fact that the ECB is not the lender of last resort for banks in need of emergency liquidity, but it is very relevant in our field to know that when it comes to the winding up of credit institutions, we still do not have any harmonization on this field. And potentially this is one of the most contestable issues after the 2 final decisions taken with regard to the non-resolution, but the winding up of the 2 Italian banks in the month of June. There is a legislation here on the winding up. We have a directive of 2001, but this is only on the mutual recognition of the measures taken by the national authorities with regard to their branches in other member states, but not on the substantial harmonization of the rules. And then I come back to my presentation before. On the left-hand side, you see the criteria laid down in the BRRD and in the regulation on the SRM, according to which a credit institution or an investment firm should be resolved. And if all these 3 criteria are met cumulatively, then you resolve the credit institution. The Spanish bank, the Banco Popular, is the typical case. The first case in which a decision was taken by the SRB, the credit institution has been considered to be failing, likely to fail, according to a decision taken by the ECB, which is basing again its own assessment on specific criteria which are laid down in the BRRD and then in the guidelines which were developed by the EBA, both on this specific criterion and on top of that on the background material on which they are working, namely the guidelines on the SREP, which is the main instrument used by the ECB in order to evaluate the viability of credit institutions. So when all three criteria are being met, you have the interim solution. You resolve the bank according to the available resolution tools, including the bail-in. You have the sale of business tool, you have the bridge institution tool, you have the bail-in tool, and you have one which goes, the asset separation, which goes cheval with one of the others. It cannot be used alone, on a standalone basis. Of course, the decision on which resolution tool will be used depends on the resolution authorities, the SRB, typically in this case, which has to take into account different aspects, including the result of the valuation that has been made on the assets and the liabilities of the failing credit institution, the credit institution under resolution. And then you have a previous case in which one of the three criteria is not being met. That was obviously the case with Monte dei Paschi di Siena. The bank could find some capital through resort to private sources, private money solution, in which case any kind of additional state aid in the form of precautionary recapitalization and under very specific conditions laid down both in the BRRD and in the regulation can be given upon the condition that at least a sufficient level of recapitalization has been achieved through resort to the private market. I will not expand on this. I know that Seraina is in a much better position to develop on this, and I know that she will do that. And then you have the third case when the bank cannot find the funds from the private sector, and nevertheless it is considered to be failing or likely to fail, the first condition always, and then its resolution is considered not necessary in the public interest. According to the conditions, we have the decisions now of the SRB. It is stating that the interconnectedness of these banks and the threat to financial stability of closing it down were not such that would render necessary its resolution. So in this case, the bank should be wound up. Typically, I would say this is the case when the deposit guarantee scheme would be activated because its deposits would become unavailable. So in this case, you have the typical triggering of deposit guarantee schemes. But we understand now that there might be some kind of state aid under national law, and Seraina will again develop on this in more details. And I think that I'm coming now closer to my 20 minutes. I have some tables. Potentially these tables will be available to the participants afterwards. And so those who are dealing with that, they know it much better than I do, which are the criteria, exactly how the failing or likely to fail criterion is being used. You have some objective elements. You take into consideration the capital position of the credit institution, the liquidity position of the credit institution, and other requirements for the so-called continuing authorization, including the governance arrangements. And you have a grading on this according to the SREP, and when it comes to an F, the grade is F, meaning failing, then you have the trigger of the resolution procedure. and I will not go into this table. Just wanted to add that in addition to the precautionary capitalization, you can still have some kind of state aid if there is a resort to the direct recapitalization instrument of the ESM. You have some form of state aid in the form of the GFSTs in the case of systemic financial crisis, but this is not of relevance for our discussion today. Very important elements, those two, but not for our discussion. This table here shows how the decision is being taken. I just remind you that the SRB is not a European institution. It does not have a legal anchor in the treaty, accordingly cannot take final decisions. So the final decisions have to be taken by the Commission with the involvement of the Council, the ECOFIN. So you have a procedure which is very complicated, but at the end of the day, I realize it worked. And it was mentioned that all this should happen within 48 hours, but I have realized that the Banco Popular, and this was, for me, one of the most striking examples, the decision was not taken over a weekend, it was taken during the week. And this is a new element, resolving a bank during a week. Potentially, the threat of this announcement was not such that the decision should have been taken over a weekend in order to prepare the markets for this resolution. And let me come to my final considerations. The final considerations are numerous. Point number one, we have a European banking union, I would say, in the making. We still have a lot of elements which are missing. The main rationale behind this initiative was, we remember the words, I state verbatim, the decision stating that we affirm it's imperative to break the vicious circle between banks and sovereigns. But allow me on this to show you this table on which we could speak for 5 hours, which we do not have today the time, which gives the link between sovereign crisis, banking crisis, monetary instability, and real economic crisis. This is just to show you that in order to insulate the banking sector from macroeconomic developments, adverse macroeconomic developments, and in order really to break the vicious circle between the banking sector and the sovereign, it takes more than creating rules on banking regulation and developing European institutions. These institutions are definitively necessary, but there is more into that. This is my point. The banking union is more than what we have already established, and that was a major development, but we need more. Another point that I would like to make, and you know from my name and from the university I teach, I'm Greek. The last 2 points are not only Greek points, but I use the opportunity of the situation in Greece to remind you that when you have huge macroeconomic failures, especially fiscal, then you need more than rules on banking regulation and banking supervision. You need some better fiscal consolidation, and this is the main link between the European Economic Union and the Banking Union, and has been addressed again and again. And one final remark, if you allow me, and I conclude with that. What if you have a banking system which is exposed to an economic situation in which, like for example in Greece or in Italy or potentially in other countries, where the average of the NPLs is over 20%? Is really the BRRD the appropriate instrument in order to deal with this kind of generalized systemic crisis? I don't know. The term systemic crisis is used in the BRRD for the GFSTs. I'm calling, my term is generalized systemic crisis, a crisis which is affecting the entire banking system. Is the BRRD the appropriate tooling for this? I don't know. I very much doubt it. I don't know, and I pass the word to Seraina. I don't know whether Seraina would advise the Swiss government to submit to the parliament a law in Switzerland, like the BRRD, for the resolution of large or small banks in Switzerland. But I think that there are some limitations to the use of the BRRD in the case of generalized systemic crisis. The BRRD might be a very good set of rules for idiosyncratic banking failures, when bank XYZ is failing or likely to fail, but when the entire system is in danger, I have some doubts. But this leaves the floor to Seraina to make her own contribution. Thank you very much for your attention, and I will be here for your questions, remarks, objections, and any other reactions that you may have. Thank you again.
Yes, hello from Zurich. I hope you can hear me. A warm thank you first to you, Pierre, for the kind introduction, and it's a great pleasure to participate in this online seminar that, as Christos already mentioned, tackles such a timely and important topic. Now, Christos has led us through the entire resolution proceeding, and what is really left to me at this point is to amplify, as Christos mentioned, the state aid resolution nexus. And one question that I would like to touch upon is, what are the alternatives to resolution that we are seeing happening? So what we have seen in the past months is really the coexistence of two parallel worlds, the new world of resolution on the one hand and the old world of state aid on the other. And it's truly remarkable that 1.5 years after the full inception of the EU's resolution framework, we have seen more cases dealt with outside resolution than within. Now, one narrative for this could be force of habit. During the crisis, it was the Commission, or more specifically DG Competition, that acted as the de facto resolution authority. It imposed burden sharing and restructuring as conditions for authorizing state aid, and thereby ensured a level playing field, and quite successfully so. Now, the BRRD then shifted the resolution powers that had been exercised by the Commission to supervisory and resolution authorities. And in practice, so this narrative would probably suggest, this transition is still somewhat ongoing. Another perhaps related narrative suggests that the old state aid world is less burdensome than the new resolution world, and therefore preferred by member states, and there might be some truth to that. What really distinguishes resolution from state aid is the stringency with which bail-in applies. The BRRD provides for a mandatory preliminary bail-in of at least 8% of total liabilities before resolution funds can be tapped to provide further funding. And this may also require converting senior debt and, if necessary, uncovered deposits. Now, somewhat unfortunately, the only example that we have seen taken care of under the new finite resolution framework, the case of Banco Popular, is in this sense not a very instructive one, as we did not see any senior debt converted or any public funds used. In contrast to the BRRD, the old world of state aid requires only equity and junior debt to contribute to loss absorption before public funds can be used. Senior creditors do not have to contribute, and there is no strict 8% bail-in rule. The old world of state aid continues to exist in the form of precautionary recapitalization and liquidation aid, and both we saw applied in the past weeks. Precautionary recapitalization, the first form of an alternative to resolution, is essentially the injection of public funds into a solvent bank to cover capital shortfall unveiled in the adverse case scenario of a stress test or an equivalent exercise. Now, unlike other forms of public financial support, it does not trigger resolution. It was meant, in the contrary, to apply to viable banks to prevent that they become failing or likely to fail and must be resolved. Therefore, the BRRD, Christos already mentioned that, attaches rather strict conditions to precautionary recapitalizations, importantly including that they must not be used to offset losses a bank has incurred or is likely to incur in the near future. Now, this condition was the very reason why precautionary recapitalization was not approved for the two Italian banks, Veneto Banca and Banca Popolare di Vicenza. But since yesterday, we know that Banca Monte dei Paschi di Siena's precautionary recap is official. It was reported that the total funds required to cover the bank's capital shortfall amount to 8.1 billion euros, of which shareholders and subordinated debt holders have contributed about half through the conversion of their bonds and the dilution of their shares. Now, retail junior bondholders who have been mis-sold, they have the possibility to seek compensation from the State Compensation Fund, which will obviously significantly reduce the amount of their contribution in the final bill. Let me move to the second case in which the state aid framework applies, liquidation, and this case comes with a different set of conditions. It takes place if the authorities consider a bank failing or likely to fail, but resolution not warranted in the public interest, as Christos mentioned. Now, in the absence of an EU insolvency law, the bank is then subject to national insolvency proceedings. And it is interesting to see in that context what one of the poll questions turned out, namely that national insolvency law is a loophole in the resolution framework. 70% of our participants seem to believe that it is rather a loophole than an integral part of the framework. Maybe we can come back to that in the discussion. I find that an extremely interesting point. So Veneto Banca and Banca Popolare di Vicenza will not be resolved but liquidated. And this opened the door for what the Commission refers to as liquidation aid. To mitigate the effects of the market exit of the two banks, the Commission approved both a cash injection and a state guarantee in the total amount of about 17 billion euros. The good parts of the two banks were transferred to a competitor. Equity and junior bonds were bailed in, but importantly, again, senior bondholders remained untouched. Additionally, like in the case of MPS, junior bondholders may be reimbursed ex post. Interesting in this second liquidation case are two observations. First, what happened here is essentially a sale of business transaction outside resolution. That is, without full bail-in. And second, apparently the authorities figured that there was not enough public interest to warrant resolution, but enough public interest to warrant liquidation aid. So the benchmark applied is obviously a different one under the European resolution framework on the one hand and the national insolvency framework on the other. Now, what can we conclude from all of that? As a general point, I think we can conclude that determining whether a bank is failing or likely to fail and whether it should be put under resolution is a gray area. The BRRD and the EBA guidelines do a fine job defining objective criteria, but eventually resolution remains a judgment call. And we will probably have to live with a certain level of uncertainty as to how cases will be handled in the future. Second, and I think the cases of the two Venetian banks only corroborate this, the uncertainty is increased by the lack of a EU insolvency law, and this really goes back also to what Christos said. We are not at the end here, there needs to come more. Now, whether or not one agrees with the bail-in regime of the BRRD, it is clear that liquidation should not be a way out of resolution. And at the same time, and that would be my third conclusion, if resolution affects the very people it is supposed to protect, something is wrong. And while the Italian banking sector may be a peculiar one, and we might be dealing with some legacy risk that is materializing here, it is questionable whether the resolution framework is flexible enough to accommodate the individual circumstances of each case. Another point in case of Christos' argument with respect to the Greek situation, which we may take up in the discussion. Eventually, this all goes back to the old question of who is best placed to shoulder the losses of a bank. Now, it is still early to draw finite conclusions at this point, as we are still in a transition period and haven't seen that many cases taking place. However, I very much expect that the BRRD review, likely to take place in 2018, will take the topic up and consider increased flexibility regarding the 8% bail-in rule. And my point on that would be that maybe really the old world was not so bad after all. Thank you very much.